Hey, good morning, everyone. Marty Mazura here. It's Wednesday, the 31st of May, 2023, with your midweek stock market snapshot. Going to look at the S&P. Want to look at the Qs, which is the ETF, QQQ, that tracks the NASDAQ 100 index. Want to take a look at NASDAQ VIX, the NASDAQ 100 volatility indicator. Compared to the index itself, I resurrected a chart I worked on years ago and updated it, and I think there's some interesting information there. And then just want to continue to beat a dead horse, as they say, and talk about breadth. In fact, this morning, that has been the major topic. I've been listening to Bloomberg TV as I go through my morning research updates, and that's their main topic. And should this breadth be an issue? And for the most part, they had bullish folks on who really said, no, it really shouldn't be, that it's really different this time. That historically, not all narrow markets where you've had such terrible breadth have ended in market collapse or big corrections and so forth. At times, the broader market will catch up to the few members of a given index that are actually rising. And I sympathize with that, and regular readers and viewers know that I try to say that just about every time. There's no assurance that it's going to play out like it did in the 1999 scenario when we had this kind of concentration in a few issues. I do think the bulls are really stretching a bit, and I think you had to live through the dot-com era to remember all the it's different this time around the internet. It was Amazon. I remember when we were somewhat critics of Bitcoin, folks like us were getting inundated with a video that showed a critic of Amazon, kind of like the critics of Bitcoin. Look what Amazon stock has done since then. You guys don't know what you're talking about. Well, Nick forwarded me that, and he and I kind of explored the history of that, and it was interesting because there was the date on the video. And ironically, yes, Amazon's been a great company, obviously, since then. But from that date to the market bottom that ensued, it suffered a 95% drawdown. And it took another decade to get back to that price that it was on the date of that video, if I recall correctly, but that's close enough. It was pretty dramatic stuff. And so, do we think AI is a big deal? Of course we do, going forward. It is definitely a game changer in terms of productivity. It has to be. AI is a risk. The Luddites, so to speak, folks who fear technology, and yes, sadly, folks lose their jobs, industries go away. But the capital that's freed up, the efficiencies that are gained, the productivity, lead to new industries, better jobs, better overall economy, that sort of thing. So the question is, how broad is that and so forth? But what's happening right now is that stocks are being bid up, NVIDIA, of course, is classic, to levels that are just almost out of this world in terms of what they're going to have to do to justify these valuations. And you know what? They may very well do it. Our problem is that as we look under the surface, we look at things like this breadth and general conditions and things that I could just rattle off, but I'll do more of that on the weekend. Second half of the year looks to be potentially dicey, but we think that could happen anytime. We think the underlying dynamics are such that something could crack and we could get something unusual to the downside that would freak people out, and that freaking out can create a panic. And then you have this whole option space that has really been holding up the market in a lot of ways that could flip, and we could have it exacerbating the downside. So there's some real risk out there that we think we still need to be careful with. We need to hedge around and so forth. But right here now for today, what I want to do again is look at the two averages that we've been tracking, look at another angle on volatility, and then once again look at breadth and compare times like these to historic periods like these. So the S&P 500, you're still in that rising wedge pattern. Let me just focus on price here first. And as you can see, we tried to break out of it here yesterday. Today, we're coming back to the bottom end of the wedge. So a break below that, right? And if that comes with any momentum, then we're going to get another sell signal here. And it looks like we're about to on the MACD anyway. So you have the worst of all worlds with this technical setup. You have a rising wedge pattern. You have bearish divergences on the MACD and the relative strength index, and then close to another sell signal here. So again, this thing is just kind of on the verge of potentially breaking down, perhaps sooner than later. I don't know that. And, we did look at this here this last time, and I said I would not, take that sell signal if I was a short-term trader. Why? Because we had the debt ceiling scenario that was no doubt going to be remedied. And, we got this big couple days here on the news that there's a deal. Well, there's maybe another pop once it passes through the House, right? So we'll see. Market's dancing around. There's been some data that's come out today that's pushed it in both directions. Right now, it's trying to stabilize. It's up a little bit off the lows. But that's the short-term stuff. We just think this market is very, very heavy. It's going to be very tough to get to new highs, to completely negate the technical setup that we have here. But, anything can happen. We'll just keep our eye on it, keep crunching the data, and keep reporting to you as we go. The NASDAQ 100 index, or the ETF that tracks it, shot through our rising wedge, so that was bullish. Tested it kind of for a second there, and now we're more in a channel right in here, and we're definitely at a new high, but we're still not burning through these divergences just yet. I think the NASDAQ is exceedingly heavy right here. And as I pointed out, I'm going to point it out again, just a handful of stocks are making that happen. Very much in overbought territory right here. The only other time we were really in overbought territory was back here in late January, right before that February decline that we had there, and into half of March. And now we're there again against bearish divergences. Just a real heavy looking setup. We'll see. Market could continue to melt higher, but I got to tell you, the rest of the troops really need to catch up here. So the VXN is the volatility index that tracks implied volatility on NASDAQ 100 options, versus the VIX, which is the volatility cost on, or tracks that on, S&P 500 options. There's a negative correlation typically, right? Meaning the volatility spikes when stocks go down. So you see that in the VIX, and in this case, the VXN, or vice versa, right? The market rises, volatility drops. So I did this some time ago, several years ago, because I just updated it this morning before I'm presenting it to you. And what I was tracking back then was periods where actually for a stretch, albeit short stretch in some periods, where the VXN actually rose as the price rose. Okay, so anytime you see a line here was where we had a stretch where the volatility index had risen, right, for a while with the actual index itself. Now the index itself is the bars, the white and the blue. This is the volatility index in here, right? So just kind of look at what we tracked here. So we had here in 2017, we had volatility spiking here, and right at the beginning the market was going up. We had a little bit of a correction in there. It wasn't big, if I recall. I think it was like 8% or something. And then before the big 20% decline in the fourth quarter of 2018, we had a couple things actually in 2018. This is where volatility spiked. They call it Volmageddon. It was only a low double-digit decline, and you can see that we get kind of blocked out in here. But before that happened, we had volatility really spiking with the VXN as the index was really spiking as well. Had another period in here, mid-2018. 2018 was a volatile year. And where 2018 fell apart was in that fourth quarter, right? But you can see we started to see the VXN achieve higher lows while the index was achieving a higher high. So there's that weird divergence. And it ultimately culminated in almost a bear market in the S&P. Intraday, it was down 19.8%. And, the Fed rescued it, yada, yada. And then we came in here to May of 2019, and you see volatility beginning to a nice higher low there. The index was spiking up, rolled over pretty hard in there. And so we had a few periods like that. The rest of the time, these weren't, I'm not drawing an arrow here because that coincided with the decline in the index and so on. And then leading into the COVID disaster, just notice, right? Because, COVID kind of hit everybody by surprise. But remember, we were hedging then because we had other indicators before we knew about COVID that said trouble's coming. And right here, this one was up a bunch. Wow, this thing was screaming higher. And we got a 35% decline, in a 3-week period of time. So here, we had a period where it went up and really not much happened in here in 2020. So, if anybody got excited about that, that was somewhat of a false signal. Here in 2021, we had it going up as price was still spiking, had a pretty good correction in there. Same kind of thing here was right up to there. And then we had this correction. 2021 again, right? These corrections that we had in 2021 often were preceded by a rise in the VXN while the price was still rising, maybe even in its last leg. And then right before the bear market or the bull market peak in the beginning of the bear market, had a big pop higher as the index was popping higher. Okay, so now pretty much I might be able to find a spot in here where it happened again, but I don't think so. This was that negative correlation almost perfectly until right now. So here lately, we've had a huge spike up in the Qs up to now the 62% of the bear market rally. So that's a key retracement, right? So the 62% retracement of this bear market, that's how much it's rallied back. There's a reason these are highlighted, because these are where technicians really get excited. They respect these levels the most. It's not at all unusual for an index to retrace 62% of its losses before it rolls back over, if indeed we are still in a bear market, which is our base case. But the thing I wanted to point out right now is we have this phenomenon that does not have to play out negatively, but it is something that has been somewhat consistent for the last several years when the Qs or the NASDAQ 100 has gotten itself into trouble. So folks are bidding up the price of protection or downside speculation on the NASDAQ 100 index right now. So something to pay attention to for sure. Okay, so on the breadth, again, don't have to spend a lot of time on this, but this is just amazing, right? Call it 9% on the S&P. Hey, the market's up nicely this year. Really? Well, the S&P 500 stocks as a group is actually negative on the year. This to me speaks more about general conditions, and that's where I was struggling with all these bullish narratives today. This is telling you things are not good in the general economy in a not small way. So I'm not in the camp that says we should just poo-poo this and not pay attention to it, particularly when you look at certain pretty serious historical analogs like we did yesterday morning. The advanced decline line, I told you we've used this for years. I really remember it back in here, and folks who are with us back in here on the videos may recall that I was drawing this. This is a consolidation range that we created back when this was happening. And I was really pointing to this breakout in breadth above the consolidation range while the S&P was still in there, right? It even came down and tested the top of that, a few months later. And plus our overall macro assessment was still bullish. So this was a pretty good decline. It was about 16% start to finish. But it was just a nauseating period. Investors were getting very impatient with the market. That was 2 years of pretty much nothing. In here, we started saying, folks, we think we're nearing the end. Breadth is really beginning to pick up. And sure enough, we bolted out of there finally, just had a great run, right? In here, you can see where breadth topped out, right? And while the index looks like, yeah, well, it was still going up, Brett topped out. We got a little bit of a decline. I remember in here, we were down 10 or 11% in the fourth quarter of 2018. I was thinking that this thing was near over. So we were doing videos back then. I was showing the Brett coming back as the index was consolidating, and then kaboom, we had that last leg down at the end of December. I remember talking to clients at the time and doing tons of videos. We did not flinch here because overall our macro assessment, general conditions were still bullish. So that what I kept saying over and over again is this is a deep correction within the context of an ongoing bull market. That turned out to be true. However, we got a false signal in here halfway down on the breadth indicator. And, everybody talks about Powell and quantitative tightening back then. I get it. But I remember that it literally was like this day. It was, I want to say the 5th, 6th of December, when the announcement that the U.S. asked the Canadian government to arrest Huawei's CFO when she landed in Canada for breaching an agreement not to do business with Iran. And so when she was arrested, and this was when the trade war was hot and heavy, the market just collapsed that last week or two. And to me, that was the catalyst that brought this thing down, because the Fed was doing what it was doing, but you won't hear that from anybody when they talk about this period. It was all about Powell and quantitative tightening and being afraid of inflation at the time. So anyway, so then we battled our way back. So here is the last year, and you can see in here what this is we had breadth flattening out while the market was rolling over, and this would have been a bullish sign. Sure enough, we got a nice rally in there, right? Since then, we had the market, short-term lower highs, higher lows on the advanced decline line, and sure enough, we got a nice pop out of there. Here, not so much, a little bit of a negative look right in there. Resoundingly negative look right now. We've got the market continuing to move higher and sharply rolling over advanced decline line. So this is the opposite of what we were seeing in 2014, 2016. This says, folks, we've had this long consolidation range in here. Breadth right now is telling us that we're probably going to break out to the downside. So we'll see. Doesn't have to play out that way, but that's what this one is telling us. And then these are really convincing to me just from a trend standpoint because they've been good indicators for us in the past. This is the number of S&P 500 members trading below their 50-day moving average. So here's the market, moving higher, hugging the 50-day, most part above it. Here is the actual breadth, right? Most stocks are going down in this scenario, right? Here we had a lower low, that's that 2016 spot, but this was a signal that we're coming out of it, right? Along with the advanced decline line that I just showed you, right? Here we are leading up to the 2018 collapse. Here we are leading up to volatility in 2019. Here we are leading up to the COVID collapse, 35%, very short period of time, got saved by government intervention. Here we had volume or breadth rolling over on the 50-day, you get it. Here we were rolling over hard before the beginning of the bear market. And here we have the market in a nice uptrend fighting its way out. Steep divergence, really low in terms of members above their 50-day moving average. This is a concerning look, no doubt about it. And then lastly, and I'll let you go, same thing on the 200-day moving average. Again, folks, this is just not a good setup. And it's so consistent with periods that we got into trouble with in the past. It doesn't mean it has to play out this way, but if anybody's wondering, why are we owning gold as a top position? Why do we keep spending money on S&P puts and this sort of thing? Folks, this is why. We will get to the next bull market. And if some people are right, we're already there. We just don't get the kinds of signals that tell us that we're there. And believe me, we are open to that. You can see we were calling that back in here when this was happening and other things that we're looking at. We did a real good job of calling this bottom right on the nose. We had actually set that as our target way back up in here. And actually, that was going to be the ultimate target if there was no recession. But now we see recession, so we think 3,200-ish makes more sense to us right here. And ironically, I'll show it to you maybe next time, on the S&P monthly chart, there's a bear flag pattern that if it plays out, takes us right to that 3,200 target if we do break below that pattern. But that would have to happen, for that flag to be valid, that needs to happen, in the next few months at most, or it negates the pattern. So I didn't load that up, and I've already taken too much time, but I'll try to remember to do that at my end of week update. Folks, I'll leave it there. Thank you, as always, for watching and listening. Be back very soon. Take care. Bye-bye.